Today is the 17th of June, 2010, and options trading. I'm not going to explain that much how it works, but I will go over the basics to options trading, and I have six different little headers here. Gambling. And like the equity market, the COMEX, the Forex, this is part of the derivative market, and it is a form of gambling. You are either going to win or you're going to lose money. It's yes, you could potentially push or break even, but the majority will either have some substantial gains or losses along the way. Speculating. Speculating is predicting or trying to guess the direction a stock is going to move. If you think it's going to go higher, then you put a call option in, and if it does go higher, your speculations are correct, you should be profiting. If you think it's going to be going lower, then that would be a put play. And if it goes lower, same sort of deal as I just mentioned about the calls going higher. And another way is speculating, say for example that you have a 401k or you're holding equities like SPY or XLF or anything of that nature, and it can be used as a hedge. And you're speculating that, well, if my stock gets hammered, I can buy some put options and then I can at least cash in that way if I lose that way. Say, for example, somebody puts 25,000 in on SPY, and then they put another 3,000 in on puts for it. Their risk is 28,000, and if the 25,000 original equity of SPY gets hammered down to 15,000, well, then they might still be in the greens because the puts can make them extreme profits. Investing. And investing, gambling, what's the difference for calculated gambling or calculated investing? And a lot of it is based on the calculations. You do, well, Fibonacci, for example. I talk a lot about Fibonacci. That's a form of calculations. There are many ways of calculations. But the final two is based on cheating and 911 airline stocks, which is the reason why I am making this video. On the spreadsheet, I have the stock code KLAC, and on June the 17th at 2:32 p.m. Eastern Time, the quote for the stock was $30.21, and this is how much the options were for July 16th, 2010. I will explain them. The call options for July 16th on $30 cost $1.40 per share to buy, $1.30 to sell. What this means is, say I were to buy some call options at $30, I pay $1.40 a share, which would cost over $140 plus commission because each option has 100 shares. And on the 16th of July, the trading day is over. Let's assume that this stock closes at $35 a share. I'd have the opportunity to buy the stock at $30 per share. And I could turn around and sell it immediately for $35, having $5 a share profit, less, of course, the cost of the options. But that's not the only way you can play options. For if I were to buy this option of $30 and say it's a few days before option expiry, the stock is $34 a share, and I look at the bid price and I see it's a little over $4. I paid $1.40, I can sell it for over $4. That's a gain of over 200%. And on the puts, say if I buy a $30 put at $1.20, the stock falls to $25. These things will be over $5 per share. So that's the basics of them. If you have any other questions, please ask some questions or go on Google and do some searches for what it is that you are looking for. Moving on. 911 article enclosed below, which is in the more information box, stated many puts were placed on United and American Airlines right before the attacks, and huge amount of volatility. And this just shows that, well, they pretty much knew what was going on. So is this cheating, investing, gambling, calculations? And if you knew this kind of information, what does this work within the karma and ethics? For heck, we all knew about BP a long time ago, and you didn't have to know about BP before it happened to cash in on it. For it took a long time for that stock to really crash down, and I don't even think it's done crashing down. But in 911, stocks lost about 1/3 of the value. These are the airline stocks, that is, right after the attacks, and therefore the puts really cashed. Stocks fell suddenly from $30 to $20 each, and I used KLAC because its price is around $30, and I wanted to find a stock at that price to show you exactly how those work. For it would not have been a surprise to see these sort of prices on September the 7th, 8th, 6th for the October 2001 options. And if you felt or knew that 911 was going to happen, you could be like, I'm going to put some $28 puts down at 55 cents, or heck, even some $25, $26 puts at 20 cents. These were not all of the options. There are many, many more, and many different time frames that can work to 2010, 11, 12, and maybe even 13 by now. I haven't seen one yet. So if we take a look at this, if you are buying a contract or 100 shares for $28 on puts at 55 cents each, it's going to cost over $60 because it's 55 for the contract, 55 cents times 100, plus the commission, and it's going to be over 5 most of the time. So that's a $60 cost. And let's assume that the stock falls to 20, which they did in 2001. Then you would most likely see the bid price rise to around $8.25. These are the ones that you bought at 55 cents. It's like buying a stock at 55 cents and then selling it at 8.25. Therefore, if you sell it at $8.25, and that means you would sell it for $8.25. This is what you bought for $60. And well, with the commission, you would get about $800 or so. And well, the profits are easily over 1,000%. Question is, say with BP, how many of these big institutions have put in big options for the put side a long time ago? We're talking like before the month of May began. And how many of these same institutions did it with American Airlines, United Airlines, Boeing, so many different related stocks? And even within the 2007, 2008 financial crises, we've seen the Dow go from 14,000 down to 7,000. And if you look at a lot of the stocks, it's not uncommon to find a stock that went from 60 to 7, or from 140 down to 20 cents even, if you look at like a Bear Stearns. Nonetheless, many stocks lost 60, 70, 80, 90% of their value, and well, the puts paid a lot of money. And since that point, over the last year and a half, a lot of them have rebounded to the upside. So if you knew in advance that the market was going to be topping in 2007, then how much money could you make by making these puts? And if you knew in advance in March of 2010 or 2009 that the markets were going to be bottoming, how many call options could you be profiting from? I'm not saying that these financial institutions have this information and make these plays, but I'm saying that it's possible. Thank you for watching and have yourself a great day. Bye-bye.